Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alcana, along with Brianna Valesky, and we have Michele Schneider on the line. She's Director of Trading Education and Research for Marketgauge. Michele, how you doing this morning?
I'm doing great. Hi, guys. Thank you for having me back. Hello, everybody listening in. It's wonderful to be here today.
So we were talking with you before we got on the line and before we went live, and just the market's just kind of in a blah phase here, and just some consolidation, wicked consolidation in the S&Ps, even getting some consolidation in the crude market. What's your take on this quiet phase in the market?
Well, I like to look at things sort of in layers. I mean, if you can picture, if you will, a terrarium, right? And let's make the market the terrarium. And so what goes in, and I'm not going to say the level of importance in terms of the layers, but just one of the layers would be the overall phase that the market is in. And all four of the indices right now are clearly in a bullish phase. And so that's one layer that has to be kept as sort of the background bias. Then another layer that I focused on a lot over the first actual 28 trading days of this year is the 6-month calendar range, because the most statistically proven edge is what happens in the range over the after the first of the year, from the first 10 trading days, which way that range breaks. Well, after the first 10 trading days, the range didn't break for 28 days, and the first one to break to the upside was NASDAQ. The last one actually was the diamond, and so now we are today, still in the bullish phase, but that second layer of the 6-month calendar range, although well above in the spiders, in the Russells, and in the NASDAQ, the diamonds are sitting right there. Okay, so that's another layer. Another layer I like to add to that is just this whole idea here of what's happening with this consolidation. So as a person that loves to speak in imagery, and considering we've just celebrated the Chinese New Year, this is the year of the sheep or the goat, which actually interesting. I learned last night at a party I went to for Chinese New Year with a good friend of mine from Qingdao, is that the actual literal Chinese interpretation of that is one that eats grass and bleats. So they don't really differentiate in China about what a sheep and goat is, but I've been using it as imagery. So what do sheep do? They're herd mentality, they pasture, they graze, and they basically hang out peacefully until a wolf comes along. So I've added a layer of the wolf looking like the volatility index. And this is all really important because this is all what goes into what's happening here with the commodities and with the specific equities in which sectors and groups are processing. So on top of the volatility index, which had a golden cross, which was the first time we have seen that for several years, since 2012, even though we're trading currently under those moving averages, we have to respect that. And then finally, there's the interest rates. Obviously, the whole global economy is in support of low rates, so we're keeping our rates low, and that's the juice that's supposed to fuel everything. So that's the stage. There we have the terrarium. We're looking at it, and now we can talk about what's going to sprout and what's going to die.
Okay, let's go into some of the commodities here and stocks that are related to those commodities. And we were just talking. I told the group when I got in here today that this is the coldest weather, wind chill, maybe not included, I've ever had in my life. In my car, it was 20 degrees in my garage. By the time I got to work, it was minus 13 here.
Oh, my God.
Yeah. So, you try to think, are there any plays from this weather, perhaps natural gas futures? Well, I see they've had a little bump and been a long downtrend here. I'm looking at this. Am I seeing, maybe I'm making things up, but am I seeing a little bit of a head and shoulders bottom here in natural gas futures?
Actually, you could be seeing that, and the neckline break would actually be probably somewhere right around where it's supposed to come in today, just a little lower. It's right now 14.90 bid at 14.99 bid at 15, and it looks like if we can get past, say, 15.15, we may have a little bit of a neckline break, but then we have the 50-day moving average coming down at 15.50. So I would say that that's very possible, and actually looking at the UNG, which is, by the way, only one. There's actually another one, FCG, and it's good to look at both, actually, because it's amazing how sometimes one goes, the other one doesn't. But if we look at UNG, it's had not such great volume over the last couple of days, although it does have a nice bottoming pattern. And it's really possible that we can make a move up to 17. There's a gap above that, a little bit higher, up to 1762. So what I would say for today is if we can hold around this 15 level and climb up, you probably have a good risk play there if you're willing to take about $1 risk or 2 times its average range. Now, if we look at FCG, that's a completely different instrument, although still natural gas. That looks better. So you may want to also examine the FCG.
And what's the symbol on that?
FCG. FCG. FCG
FCG.
is the
okay.
FCG. Yes,
okay.
And FCG is the also a natural gas ETF. It doesn't have the same amount of volume that UNG has, but I actually think it is a little bit saner trading instrument, and that actually has gone into a recovery phase. So in other words, that has now taken out the 50-day moving average, is holding above, had better volume yesterday than what natural gas did in the UNG ETF. So you may even want to look at that. And that also has somewhat of a head and shoulders bottom. And Joey, you're talking technicals to me here, I see today. So 12 would be the number there, and it's coming in just around 12 on the open here. So yes, I would say both of those. And of course, if we just look at oil itself, USO, you know, that looks like it's bottomed, and even though we sort of peaked around the 50-day moving average over the last few days, we have tremendous support at 18, and if we can get back through $20, I think that's also going to continue to go up.
Wow, that's a pretty clean chart there on the USO. I mean, I look at the crude chart as well, and that's kind of wiggly here. But you know, I mean, that's oil. We're doing actually an entire segment on oil next week here, and you think we've seen the bottom here in oil? I mean, maybe a multi-year bottom?
You know, I don't know about a multi-year bottom, although it's certainly possible. I mean, this whole year to me was one where we had to focus on commodities or things that really had been so negatively impacted over the last several years that now would show signs of a bottom. And that's been a big theme of mine, and actually not only in oil, we've been trading in the oil, but also in some of the other commodities like cotton and corn, which are also trying to bottom. And so I think commodities in general is definitely a good play. I mean, obviously, with oil, we have some political situation there, and you know, there's also just the astral inventory. But, you know, we are certainly going to be impacted by changes in the climate, like you said, this absolutely freezing cold winter that you've got going on in the Northeast. By the way, lovely here in the Southwest. And so, yeah, I would say all of these have potential. They all look like they bottom. When I look at the USO chart, it had a strong reversal pattern at the end of January with excellent volume. That's what you want to see. You want to see interest coming in at these sort of peak reversals. We had it. We immediately popped up. Maybe it was a little bit too exuberant, so we're consolidating. So like I said, 18 to 20 is our range. Right now, we get through 20. I definitely would say we look good to 25, maybe even 28, and then we can have another discussion.
Okay, we were with our prior guests. We were talking about this consolidation in the S&Ps and the low volatility here. I know you do some work on the indexes. Just a pause here up near all-time highs. Is this just a pause to break out and move higher here, or maybe we got a little work to do on the downside?
Well, actually, so I go back to what I said in the beginning. So if we examine this in its layers, right now what we have to say is the base is bullish. We're over the 6-month calendar range, which usually typically means that over the next 6 months or till the end of June, the bias is positive. That doesn't mean that, you know, we won't see down moves and that sort of thing. But because of all of the mixed news and because of volatility, the fear factor has definitely, although still there, has subsided. I would now vote more for consolidation And that doesn't mean we couldn't dip, but I actually think that this level of consolidation is a good sign for the market, and it's just waiting for something. Greece to come to the table. Maybe, obviously right now that's where everybody's eyes are, or Greece to become less impactful, because people just get sort of used to it. You know how it is with news these days. It's all about perception, and because everything travels so fast, the perception is one way 1 minute, next way it's completely different. So today, right now, it's putting a little pressure on the market. But if you think about it, other than the Dow, which is down pre-market about 0.5%, we're practically unchanged in the Russells and in the Qs. So SPY is important to watch. You know what's even more important to watch? I think, my opinion, IWM.
Okay, let's talk about the small tech. Sometimes a leader. What's your technical take on the IWM?
Well, if you go back to 2014, we actually broke out of a year-long range. So where I'm talking January calendar ranges in NASDAQ, SPDR, and the diamonds, in the Russells, it's been a year-long range that we broke out of. So that would tell me that dips are buy opportunities, we're consolidating near the highs, and it has a tremendous amount of potential to go much higher. That's what I believe. And that relates directly to some of the strength that we've seen in the pockets of the U.S. economy and the stronger dollar. So I have my eyes there. We're actually long IWM for the last several days, and we're doing this for a momentum play to think that perhaps, if we can hold, let's say, around this 120 level in IWM, that we can actually see a move. Who knows? I don't even want to venture to say, because I think it's dangerous when you try to make projections. But I think we can definitely see a tremendous move to the upside there. Of course, there's no wolves in sheep clothing hanging out there and something really horrible happens. But at this point, I would have to say positive bias for sure, IWM being my favorite, NASDAQ being second.
I looked at that. I haven't looked at this chart. I mean, I try not to go shorter than like 15-minute time frames. I look at dailies. I also try and look at weeklies here. And boy, that's an excellent point that you have there. I'm going back here to 2014, the whole year. You had a nice trading range, and then you did break out to the upside there. So that could bode well for the market. Any other sectors or stocks that are on your radar to hear? I mean, you can buy your high flyers, your Apples, these stocks that have been moving up. Do you think there's anything that's like near support or, a lower risk buy? I'm not sure if you follow the 3D printing stocks, but you've had some consolidation in that. Is there still finding any value in any equities in the market?
Oh, absolutely. And again, it's interesting you would bring up 3D, because that is something that I'm super focused on. Again, kind of like what we just discussed with natural gas and oil. It's had a tremendous down move. It had a terrible year in 2014, and it looks like it's basing out in 2015. Now, it reports earnings, I believe, next week on the 26th. So I personally am waiting for the earnings report to come out. I would not want to take a position ahead of that. But 3D printing has not had a positive earnings report in quite some time. And so I believe now with this bottoming formation, the expectation could be more positive for this next earnings report. And I know you have people who come on the show who are much more adept at analyzing EPS and all that stuff. I'm much more on the technical side of things. But I would say we get through 35 in 3D, and we're good to go.
Okay, I'm going to give you, we only got a few minutes left here, and I want to just rapid fire some. You got your charts in front of you, right?
Okay, yes,
yeah,
I do.
I just want to rapid fire 3 or 4 stocks here before we let you go, some movers that we got here. And just get your quick comments. Only technical. The fundamentals, we're just putting these out for our shorter-term traders. NDLS, noodles. Get noodled here. NDLS.
NDLS. Okay, this is a new one on me, but it doesn't matter what it is as long as... Oh, interesting. Okay, so in this particular chart, we've broken out now over the 10, the 50, and the 200-day moving averages. Okay?
You don't have the pre-market chart, though, do you?
I have only right now that, it's down 27%. I just looked up. I was looking at the Wow, what happened there?
They missed by they missed by a penny here. So just your trader gut instinct here on something like this. When you're looking
Oh,
at
well,
the
okay.
chart, let's just go from your gut here, Mish. What are you saying on this one?
Well, I'll take it one step better. If you are a short-term day trader type person, what you do is you fade or follow the gap when you have a gap that big. You use a 2-minute opening range. So you wait for the first 2 minutes. If after the first 2 minutes it breaks out to the upside, you follow it and you put your stop in under the low. If it breaks down to the downside, then you put the stop in under the high, and you basically scalp it. So you're not going to be sitting with that trade all day, but you may sit with it for the first 15 to 20, maybe even 30 minutes of the day. And so that's the scalp move on those tremendous gaps. Now, interestingly enough, 20 is support. So I would assume that you might get a 2-minute fade the gap. So buy the gap after 2 minutes if it sets up.
Okay, I like that. I like that. You know why we like it? Because it's specific rules. You're not making an opinion. You're just following your rules. Okay, how about one going the other way? How about ANET? ANET. Going the other way. Do you still apply that site kind of thinking to this one?
Oh, wait, so it's A-N-P-T?
ANET.
Oh, yeah, A-N-E-T. Okay. Let's see what that looks like here. Oh, okay, so that's up about 10% pre-market. I would probably say the same exact rule applies with this one too. Use that 2-minute follow or fade the gap, and especially right now it's coming in under 75, but 75 is a pivotal level. So if you bought the 2-minute gap breakout and you couldn't get through 75, you may want to get out. Only because that seems to be such a big chart point. But otherwise, yeah, same deal. Either sell it on a 2-minute breakout, and you could see a move down, or buy it on a 2-minute breakout.
Okay, all right.
You got to move fast. I don't do that so much anymore, but it's a wonderful tool.
Okay. All right. Well, thank you. We've been on the line with Michele Schneider, and she is a director of education and trading. So we will have you on again. Thank you very much, and we'll talk to you again soon.
Thank you, Joel. Thank you, Brianna. I look forward to seeing you guys again.
Okay. All right. We are going to take our final break of the day, and we are going to bring on a great guest who's made some great calls in the market, Reverend Emmanuel Lemelson. He's the Chief Investment Officer of Lemelson Capital Management. We'll be right back.